Hello and welcome to today's episode of Nucleus Investment Insights. Today, we're going to talk about the impact rising interest rates are having on housing affordability and the implications for the property market as a whole. As you're likely aware, the RBA has raised interest rates at its fastest rate in about 50 years, and this has led to some of the worst valuation metrics on record. So we'll delve into these in detail, and we'll also have a look at our comprehensive property calculator in the second half of the show. And in this calculator, we can talk through some different scenarios, like, for example, whether it's better to rent or buy and the different outcomes of investing in property versus shares. My name's Sam Kerr. I'm the Senior Financial Advisor at Nucleus Wealth. Today, as always, I want to welcome the Founder and Chief Investment Officer at Nucleus Wealth, Damien Klassen. Damien, thanks for coming on the show and sharing your knowledge as always.
Sam, thanks.
Excellent. So this is a topic on everyone's mind, so I'm sure many people are looking forward to your insights. Just a little bit of housekeeping before we get started. If you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, you can follow us on your preferred podcast platform. Our show is available on all the majors. Just one thing I want to mention before we get started. If you want to have a look at the slides in more detail, we'll post them in the show notes after the show, and you can view these at nucleuswealth.com/webinars. And we'll also put some links into the slides for the recent monthly property updates and articles that Damien writes. So you can view those at nucleuswealth.com/webinars. So now we've got that housekeeping out of the way, we'll get started. So Damien, over to you.
Yeah, thanks, Sam. Let's start with the RBA. So, and what the markets are currently pricing in. So at the moment, its official rate's 1.35%. That sort of translates to a mortgage rate of about 4.7. And then I've got this chart up showing the interbank cash rate implied yield curve, and basically what this is saying is if you strip out what's priced in at the moment, you can see what the market is expecting in terms of interest rate rises. So you can see that next month they're expecting or they've priced in pretty close to another 50 basis points. Certainly by September that's in there, and then by February next year, so you got about sort of six or 7 odd months, or March I guess, where it's peaking about 2% higher than where it is today. So interest rates are probably around about 6.7 to 7% interest rates at that point. You'd expect that from the banks to be there. So lots sort of priced in. It's quite the rate already has been quite extraordinary. So I've got a chart up just showing that the changes in mortgage payments over a 1-year period. And this is on a 80% mortgage with over 25 years, and you've basically had over a 30% increase in the mortgage payments already. It's basically the fastest ever, sort of equal with a one right back in the 1970s. But you can see it is for new home buyers, it is a dramatic change in the affordability and what you can put down. If you go to where the markets are expecting, that is looking so relative to where we were last year. It's closer to a 60% increase in the mortgage payment on over a 25-year period. And keeping in mind, obviously not everyone's got a mortgage that runs for 25 years. It's sort of a bit of pretty close to a straight line in terms of in terms of what you see there. So so I guess a 30% odd increase in 1 year at the moment. If you only had a 12.5-year mortgage, then you're looking at about a 15% increase in your mortgage payments. So it's but significant is nevertheless the increases in mortgage payments that we've seen. So I guess what I'm saying is we've already seen record tightening, and we're expected to basically do the same again in terms of interest rate rises. Or that's what the market's pricing in at the moment. So what does that actually mean for the outlook? Well, we've got our housing drivers, sort of short term, that we And these are designed to sort of give you an idea of what's sort of driving us at the margin. So I've got two ways I look at the housing market. One is these short-term factors that are going to push the housing market over the next year or two. And then secondly is these longer-term valuation metrics that we talk about the market coming back to. And I'll deal with those in a second, but let's just do the short-term ones first. So what we're looking at here is just a chart of sort of demand and supply factors. So the demand factors we look at is credit availability. Now, why that's important? We saw that in 2018 when we had the Banking Royal Commission, and basically all the banks pulled back on what they would actually lend. So we've certainly had some slowing in terms of credit availability. It's not pouring out as fast as it was. There's been some APRA changes, but we're certainly not restrictive. And the issue that usually happens with when you get housing market sort of pullbacks or housing market crashes is that banks it's pro-cyclical. When things are great and prices are going up, they throw as much credit out there as they can. And then when houses start to fall and they get concerned about loans, they actually start to pull back on credit at the same time as things start to go badly. So which then makes things go worse because it's harder to lend. And so and I guess the point I'm making on this chart was basically we had a housing, so some reasonable housing price falls in sort of 2018, really just based on the withdrawal of credit from the market at that time. And that was sort of the banks anticipating what was going to come out of the Royal Commission. When the Royal Commission, I guess most of the recommendations from the Royal Commission, when they weren't implemented, then that's when the banks sort of got going again and started pushing out credit. So over the last year or two, they've been pushing out plenty of credit, which sort of helped to sort of drive that price. At the same time, with the price of credit, had some dramatic falls, and we had the RBA, out there effectively funding banks by giving them cheaper loans than what state governments could borrow at, for giving to banks, as long as they were putting it into their 3-year mortgages. And now that's reversed. So we're seeing the fastest rise in the price of credit. And so that's sort of a huge negative in terms of in terms of the short-term factors on housing, and that's why we're seeing house prices roll over already, and quite likely to see house prices continue to fall. Your next short-term factor is employment. It's a neutral at the moment. Wage growth's improving, but it's at record lows. We've got great unemployment. The problem is, that we haven't seen a lot of wage growth. And now the question is, will that start to reverse? So we're in this rapidly rising rate environment. Will unemployment just came out as I think a record, certainly a record over in recent times, record low. And then the question is, as these interest rates rise, how much will that start to reverse and become a negative? Population growth is another one. So we've all heard about the amount of uni students and running population immigration levels much higher than we've ever seen before over the last sort of 10 or so years. That reversed in terms of COVID. So we basically got back to net zero. I've got a question mark on where it goes. So there's certainly governments are trying to throw open the borders. The federal government sort of come out with some visa sort of offers and trying to sort of drive this again to get that population growth going again. But we really haven't seen much of it. So I guess there's a question about there's just this real question in a post-COVID world about if people are concerned about lockdowns and I guess how Australia treated sort of university students and foreign university students during lockdowns. There's this question about, well, if I'm not quite sure if there are going to be more lockdowns, do I want to be in a different country? I might not be able to get work. I won't be earning any money. Government handouts seem to go to citizens, not to students. And so, there's this idea that will that population growth that the government wants, will that actually come on or not? And so, yet to be seen, but certainly to date, it's the population growth has been very weak, much lower than what I think the government would have hoped for. Foreign buyers is another one. So, in the boom years, so we had when we had our Joe Hockey was the treasurer. We spoke about sort of actually cracking down on the foreign buyers, and there was a couple of forced sales, and they were looking at beefing up the force that was actually looking at foreign buyers. So foreign buyers aren't officially allowed to buy existing houses. They're actually only meant to be buying new houses, but it's just very poorly policed, and actually the net effect of it often is the fines are so small that for most people it's no it's no discouragement. Then in those boom years, once Hockey was no longer the treasurer, it basically reversed, and they basically just ignored it again and allowed foreign buyers to do it. So there are rules against it buying it, but they just don't get enforced. Then once we saw the question now is Chinese buyers. There's obviously still a lot of tension between Australia and China. Our expectation is that that's not going to be easing anytime soon, and that means your average Chinese buyer who sort of helped to drive the market in the boom years is no longer going to be looking to pour money into the Australian market. In terms of tax incentives, there's plenty of those still out. Lots of government support still for housing. So we're expecting that to keep going as a short-term factor. Money laundering, we had, for anyone who didn't catch it, we had an expert on just recently, Nathan, sorry, complete mental blank on his surname. Sam, help me out. Who's written the book, The Lucky Laundry. Yes. And yes. And so, and I guess he was highlighting that there is this chance that Australia will finally put the money laundering rules onto the property market. So the summary basically is that Australia is one of I think 5 countries left in the world who haven't actually put the anti-money laundering laws on the property market, and that somewhere between I think $10 to $50 billion every year from criminal proceeds sort of ends up in Australian housing because nobody's looking at it. So there is proposals. He was quite hopeful that a Labor government would put them in. But we certainly haven't seen any sign of it yet. Austrac, was only just recently came out and highlighted the continued issues in terms of money laundering in the property market. So maybe it'll come on, and maybe that'll be negative, but we certainly can't see it at the moment. And you'll probably get at least 6 or 12 months, I guess, forward indication of when that will come on anyway. So once they actually get the legislation, start arguing about it, put it back to industry, that's probably six months or so, and then the implementation is probably going to be at least 6 months or maybe longer in terms of giving real estate agents and the like enough time to make changes to put that in. So so money laundering still a positive, short-term positive.
And Damien, just interest rates, they're obviously the biggest driver of
interest rates and credit availability.
Yeah,
two biggest, I would say.
And interest rates are obviously on the rise, but what impact does the population growth, just sort of just growing at natural rates rather than through immigration, and also the drying up of foreign buyers, what impact do you think that's going to have?
Look, on its own, a reasonable impact. I guess I think of housing as more of an economic than actually. So I think there's probably a later slide which actually might answer this a little bit better. Actually, that might even be the next one. Let me just double check. It's basically I've got one sort of 2 slides on just talking about sort of this rough idea of stock and flow, and so it probably sort of fits well with what you're asking here. So every year, Australia builds about 100,000 to 200,000 new houses, and some of those are knockdowns, and so there's new houses coming on all the time. You get about 2.6 people per house, and so if you're building 100,000 new houses, then theoretically that gets you enough room to fit 260,000 people. Some of those though are new people, and some of them are people that are you've knocked down a house to do it, and so you haven't really added to supply. So that's where you are with that. Then you've got about 11 million houses in total. So your actual amount of building per year is very, very small relative to the amount of houses we've got. 11% of those houses don't have anyone in them. So the idea there is that effectively what you've got is people who are either have multiple homes. They might have an apartment and a house in the country, and sort of live in both. People with holiday homes who don't rent them out, or Airbnbs sort of count there because that's not actually somebody's official home. People go there for holidays, but people don't actually live in that as a full time. So you've got these unoccupied houses, and you don't need to change that very much to actually make a huge difference. So if you change that by, we've got 2.6 people per dwelling at the moment. If you change it to 2.7 people, there's actually another 350 extra houses, 350,000 extra houses you've just freed up. If you change it the other way to 2.5, you've actually got it, another 350 houses that you've of supply that you can bring on. So your annual supply really depends upon movements in this ratio of 2.6. How far does that go? And then you're unoccupied as well. So so if you change your unoccupied from, I've used the example here, 10.5 to 11.4%, that gives you another 150,000 new dwellings. So and they're, to me, they're economic indicators. So if the economy is going well, people are making money, then kids move out of their home. Kids move out of their parents' house faster. People who are living in share accommodation can afford to have one less flatmate. People who are thinking about, do I buy a holiday house and just, and I'll just keep it for myself, or I'll buy an apartment in the city, so I can stay in there and stay in there a couple of nights a week and stay in my country house a few times a week. Those types of things, those economic factors are what drives that 2.6 people per dwelling. And that has a far bigger impact than sort of small changes in the number of people coming into the house or the number of houses being built. So I guess where I'm getting to is, yes, in the longer term, that makes a difference if you've got people coming on and you're not building enough houses, or if you've got if you've got more foreigners coming in and you're not building enough houses, and it does make a short-term difference, which is why I've got it up on this list of saying, it does make a difference at the margin. But I do think the bigger factor really is an economic one. About it's not about how many houses we build, in the short term, it's not about as many houses as you build. It's about this economic idea: how many people are living in each house, and how many people have got spare houses, so to speak. Does that make sense?
Yeah, that makes sense. And I guess we've had a bit of a reshuffling through COVID. People wanting to see changes.
Need extra room for your for your study. All that stuff like that. Yeah. People want houses rather than units. So you're that's present company included, Sam?
Indeed. Yeah. We all want more space, don't we?
Yeah. Well, some of us do. Some of us. I'm going the other way. I've got kids moving out, so there's but I guess the idea, the idea with that is that foreign buyers maybe that's actually freeing up some more space, because if there are, say you've got a foreign buyer who buys a property in order to get money out of a country that they the money may or may not be illicit funds. They're just trying to get out of the country, and they're just going to leave that place empty and come visit a couple of times a year. Then by them not buying that place, that might be a good thing for supply, because now actually somebody local's bought it, and you've got more supply in the market. So but if you've got foreign buyers who are coming in buying and then renting it out, there's maybe it pushes prices higher. So I guess there's a few of those that are sort of double-edged.
Yeah, lots of different factors at play.
The supply factors then, restrictive planning. So look, Australia's got I've put a small one, because I do think it is mildly restrictive. The property developers complain bitterly about how restrictive it is. I guess for them, most of them are sitting on 20 plus years of property, and they drip the property out very, very slowly. So I think as much as they complain about restrictive planning, it's hard to on one hand complain about restrictive planning and on the other hand have all this land sitting on your books that you've got 15 years or 20 years worth of your next building things already booked in, and so there's some element to it, but we're certainly there's no real significant changes to planning processes that are planned at the moment and legislation that's going through under an oversupply. So we've sort of this is a mixed bag. So we've got a lot of building in progress at the moment. So we had the home builder support, and so there's a lot of building which is sort of just coming onto the market. On the flip side, there's a bunch of developers that are collapsing at the moment. Sort of caught in this squeeze between fixed price contracts and inflationary pressures on housing materials. So so your short term factors are a little bit both ways. And then the last one, the structural change, which is sort of a new one I added sort of post-COVID, which is this idea that we were just talking about there that, that's a positive for house prices. So all the green arrows here, are positives. So that's more of a positive than a negative because there's a desire for houses versus units. There's a desire for more sort of regional versus city. So there's that structural change and people wanting that extra space so they can have home offices and things like that. I do think is a positive for house prices in terms of people wanting to, make. So just to confirm, green sort of means it's something which will affect push house prices up, and red means it's something we think will at the margin push house prices down. But overall, from this slide, the thing to remember is it's the price of credit. That's the one which I feel, as much as you've got all these other factors that are helping, the price of credit is going to trump all those factors, given the speed at which it's going up. Right. So hopefully that makes any other questions you had on that one, Sam?
I think that's all pretty clear for the moment.
So that's all.
A few comments coming through. Just asking about, is now a good time to buy, or is it still risky? But I mean, I don't know if you can really answer that one.
Well, it's not personal advice or whatever, but I guess what I'd say is, in terms of rising interest rates, if you're expecting interest rates to go to what the market's pricing into, sort of 7%, then that's sort of off the charts in terms of the changes. Like we've already seen the biggest changes ever every year. That's just sort of doubling that again. And there was the other factor with that. And quite possibly slowing employment factors and a whole bunch of other factors. And Australia's got way more debt than we used to have in the 1970s anyway. You're basically expecting some other factor to come out. That's something to come out of left field that's going to drive house prices higher, because interest rates are the way things look at the moment. Interest rates are really going to smash them. But let's go into some of those longer term factors, because I think that's where we look at which is what we've generated this property calculator for. And the idea is that in the longer term, mortgage payments have some bearing on rent. So at the moment, if you're buying a house in Sydney, your mortgage payments are roughly double what the rent is for an equivalent house. And so at that point, at some point, we believe people have to sit and look and go, well, okay, it's going to cost me $1,000 a week to rent this house, and it's going to cost me $2,000 a week to buy it. Maybe I'll just rent for a while and hope those prices will come back, because there is, it does, when it gets to extreme levels, so I guess what we're saying is that that's a series which we think will revert back to a more reasonable level, or certainly sort of pulled back to a number. Mortgage payments to wages is similar in terms of saying, well, the amount of people's wages that they will spend on their house has some sort of limit. We sort of showed numbers over the last sort of 30, 40 years on our charts, and we do acknowledge that there is a rise in terms of more sort of two-income families and things like that will make a bit of a difference to that. How much can be afforded, but in the end, there is some limit in terms of people have to be able to afford what they're buying, and I think both those two are more important as a longer term factor, because they're ongoing payments that need to be made. the property price to wages makes a difference because people need to save a deposit, but again, it's a one-off. That's a one-off effect, and there are ways people can get, whether it's bonuses or they can get loans from parents or gifts from grandparents or whatever it is, that can actually help them get on into the market. But it's more about the mortgage payments to rent and mortgage payments to wages. We believe that sort of drives the longer term affordability. And then last of all, you got your rental yields, which is your investor returns. I don't think there's many investors out there buying property over the last few years for the rental yield. It's all about the capital gain, because the rental yields, quite frankly, don't really add up from after costs. There's a lot of places that are negative in terms of the rental yield you can get on them. And so, I think it's a factor. It is a factor that sort of should go into your arithmetic, but at the moment it's not a factor we think that's making too much of a difference. So I spoke about a little bit this stock versus flow. Let's jump on to have a quick look at some of the actual ratios that we're seeing. So property valuation ratios, we're looking at about so I spoke about the mortgage payment to rent in Sydney is now 207%. So basically, there's that idea that if you could rent a house for $1,000 a week, you're paying $2,070 for that house as a mortgage, and that's before we get another 5%, half percent increase or another 2% increase in interest rates, and that's effectively the highest it's ever been in Sydney. Your mortgage payment to a full-time wage is at 85% of a full-time wage. So again, pretty close to all-time record highs there. Melbourne's a fair way behind that, but still extraordinarily high. You're still paying 83% more than the cost of renting, for the honor of having a house, and then drops away in some of the other states. So that's the absolute numbers there. What I'm going to do, though, is jump to some of the relative figures. Actually, I'll do the 3-month changes first. And then we'll look at how that sits versus history, because that's what's more important, I think, in terms of knowing where markets have been in the past. So over the 3 months, the mortgage payments to rent has all sort of gone up by sort of 15% ish on most of the markets. Some of them are only up 10. But it's significantly higher in terms of mortgage payment to full-time wage. Again, you've sort of 3% at the bottom, but well over 5% increase in terms of the your mortgage payment relative to a full-time wage. Some of the property price have declined, and the gross yields have improved a little bit. So certainly Sydney house prices have started to fall, and Melbourne house prices have started to fall. We've also seen rental yields increasing quite quickly in both those markets, and so that means that some of those figures are starting to help in terms of looking at your gross rental yield, for example, is improving there, but they're still not.
Damien, is the gross rental yield, is that increasing because of the house price falls, or are rents going up as well?
Both. Both. So it's mostly I'd say that's probably relatively equal in terms of what's come through. Okay, so then we look at the final one I wanted to show, which is probably gives the most information, is what I've done is I've put all of these as a percentile. So basically, when I look at the Sydney housing market and say, okay, so trading at 207% of is your mortgage payment relative to your rent, where's that relative to where it's been in the past? And it's at the 100th percentile. So the top 1% of all records is where it's at. Melbourne, even though Melbourne was only at 170 or 180 or whatever it was, that's at the 98th percentile. So it's higher than at all times except for 2% of the records. And so as you look across these, so as you can see, Sydney is on 4 of the 5 measures is basically as expensive as it ever gets on all those measures, and Melbourne is not far behind. Brisbane's a little bit better. and the only one you sort of say is sort of semi-reasonable is your Perth houses. That's in the housing market. When you get into the unit markets, Brisbane, Adelaide, Perth, they're all actually, there's still reasonable affordability relative to where they've been in the past in all those markets. And I guess that's, a lot of that is this demand for people. There's this demand we spoke about, people wanting to move into houses and add up units. And that's what's sort of meaning that the unit prices haven't risen as much as what we've seen house prices rise. And they're generally paying better yields as well. So, yeah. So, yes. So if I want to jump into a few of those markets just to sort of show you sort of graphically. Actually, let me do the macro factors first. So you can see again, just looking at how things are on this idea of a percentile. So mortgage rates of 4.7%. They're actually not that expensive relative to history. So we're actually only in the 16% of the time they've been at the current rate or lower. So 80 something percent of the time they've been higher than where they are today. Having said that, though, Australia's got way more debt than it had at any time back in the periods where mortgage rates were higher, and so the effect of that interest rates will have a much larger effect on the economy. Inflation is still running quite hot. Keeping in mind that sort of inflation is a lagging indicator for some of these. Wage growth. Now I've got the 3-year wage growth one. I should have actually put up the current wage growth. On a 3-year wage growth, the average, the real wage growth is terrible. It's below inflation. And the reason why I use 3-year averages is just because the actual series are a bit too, they jump around a bit too much to get information from it. But so wage growth has been a bit stronger recently. Not strong. It's just been better than the really low levels it's been at over the last few years. But both on a 3-year basis, both nominal wages and real wages have been very weak. And then we can also see that right at the end there, we've got this big bounce in rents that we spoke about. So huge increase in rents in the last quarter. Now the question is, is that sustainable? Can that, if you're looking at houses and you're going, look, rents are going to grow at, 6-7% per annum for the next 5 years, then you've been in a much better position than if you're looking at what rents have grown at in the past. So I've got a blue line on this graph that shows the real rental growth. So that's the rental growth above or below inflation, and typically it's about the same as inflation in terms of rental growth. So you get a number of years of above growth and a number of years of below growth. We've just been through this period where we've been growing below inflation for a long time. The latest quarter is looking like it's probably going to be above inflation for the first time in maybe 5 or 6 years. But rental growth in the longer term is quite low. And the other thing to remember as well with this rental growth series is this isn't necessarily talking about your property. So this is talking about the average property. And there's always new houses being added to the market, and there's always people renovating and doing new things. And so you'd expect that the average property is actually getting better over time. So if you're just looking at a single property and with it that hasn't been renovated and hasn't been sort of redeveloped, then chances are that rental growth is going to be worse than what you're seeing in this series, because this is sort of the composition of this series is changing. So let me jump to Brisbane houses just to give you an idea. Brisbane houses and units, just to give you a bit of an idea of some of those numbers. So, and you can grab all these yourself off the property calculator if you want to jump in and you've got a particular market you want to look at, or in the detailed report, I sort of jump in and have a section on each of the markets. But the main one I wanted to point out with Brisbane is it's now, say, on the mortgage payments to wages, it's now at the 95th percentile. So and it's rocketed there. So go back a year, and this is this point about the increase in the mortgages plus the increase in prices we've seen in Brisbane, is that it was pretty cheap actually in terms of Brisbane houses. But given both the increases in prices and the increases in mortgage rates, it's gone from I think it was sort of about the 30th percentile or something like that to the 95th percentile pretty quickly. Similar story, not quite as bad in mortgage payments to rent. But then if you flip across to the other side and have a look at on the right, we've got the units, and they're not too bad. Like they're still, your mortgage payment to wages is at the 22nd percentile. Mortgage payment to rent is at the 37th percentile. And I guess what that's reflecting is that the prices of units in Brisbane really haven't moved very far. So they're still relatively affordable, versus history in terms of that market. But I guess the thing is they've seen some of the biggest changes in terms of affordability. If I jump to the Perth market, that's the one where it's still relatively affordable across a lot of these. The mortgage payment to rent is sort of at the 58th percentile, so still sort of roughly average over the longer term. Mortgage payments to wages is a little bit higher, but it's not nowhere near the extreme levels we're seeing elsewhere. And a large part of that is because you saw such big falls in Perth houses, right throughout the from 2010 to 2018. You saw some significant falls in Perth houses, and that means that the Perth units are still looking relatively cheap as well on these measures. Probably a bigger issue for Perth is picking your resources and working out whether, if you think that gas prices are going to stay high, and chances are they will, given what's happening in Europe, unless you get some sort of sudden resolution to the Russia-Ukraine situation, then that's obviously a good thing for Perth prices in terms of the amount of employment that goes into the gas sector. And the flip side is there's a lot in the mining though as well. And that's very much dependent upon Chinese housing, and the Chinese housing is not looking good though. That's so you've got two parts to that. But if you've got a strong view on both those, that I guess interest rates won't go as high in Australia, and you had a strong view on the gas prices were going to be good and that resources are going to be good, then Perth housing it would be attractive under those scenarios. But then a question about which of those three are you're more negative on. And the final one I just wanted to show as well is then the Sydney house market, just sort of showing that those the mortgage payment to median wages. You can see over that sort of 40 odd year period that 50% ish, I guess, maybe a little bit higher than 50% in some periods, and we basically peaked in the 87 when you saw your 20% mortgage rates. You peaked at sort of 80%, and we're already at 85% of your mortgage payment to median wage. Having said that, there's probably more people per household are working at the moment, so that sort of evens out a little bit. Your mortgage payment to rent, though, you don't have that same argument, and again, higher than what it was in the 80s, higher than what it was right throughout the 2000s. So yeah, it's never been more expensive to buy somewhere. And then the final bit is your property payment to median wage, where it has been falling back in recent times as property prices have fallen away. So yeah. So that's the sort of three markets I wanted to pick on, but you can see all those markets in that detailed report we have on the website. So property calculator. Oh, sorry, any questions there, Sam? There should be.
So we've had a couple come through on the chat. So we have one question here from Mike Delta. He's saying, do you think a recession will have people move back to the cities where the jobs are, and will this impact regional property values?
Yeah, it's a good question. Look, I don't know, because the question is as well. Most regional areas should be able to grow the population, grow the housing stock much more easily. There's plenty of room and space. Australia is a very, very big country, relative to say something like England that sort of fits, twice as many people into, I don't know, a 20th of the space or something like that. So there's certainly plenty of room to grow. To me, it's been the growth in regional has been this idea of people, the sea change of people wanting to get out of the cities who can now work from home a lot more. I do think that work from home will probably be around, but but I don't know. So maybe if there's a mixture of increase in unemployment and companies start forcing people to come back into the office, then I think you're right. But the other factor is because there's it's much easier to buy much easier to build in regional areas. You would expect that supply will come on to sort of force those prices back down. There's just a question about when and whether it's fast enough, or is the exodus to regional areas, is that if prices fall, does that mean there'll be more exodus that'll push prices back up, and you sort of keep going until for some time? So that's the so it's a good question. I really don't know the answer to that one, but
I guess time will tell.
Yeah, that's right. And the whole work from home bit, obviously there's a lot of companies that do want more people back in the office and are sort of fighting to get people back into the office. But there's plenty of companies that are saying, well, this is fine. People are productive and we're happy to have them work from home. So, don't know what the final answer will be.
Okay, great. So let's go to the property calculator. I just want to clarify one thing. It was Nathan Lynch from Lucky Laundry, who published Lucky Laundry recently. So just wanted to clarify that. Apologies, Nathan. But here's another plug for your book. So Lucky Laundry. Cool. Have you? Okay, you've got the property.
Yeah, I thought what I'd do is I'd show the output first of this, just to sort of show you what I'm trying to do behind this, and then so we'll stick with the slides for a minute, and
Okay.
I'll let me do that, and then I'll jump to the property calculator and we'll go through a live example. So the idea is I've just got here, Sydney house, $1 million with a $200,000 deposit and 4% interest rate. So assuming that interest rates fall from where they are back to 4%. And saying, okay, what is that? And now you've got four different factors across the top that I can choose as what's my valuation metric going to be. So in this one, I've chosen mortgage payments to rent, and I've said, okay, well, we're at 207% now. The 30-year average and the 10-year average are sort of shown on that chart as the yellow and the green lines. And they're significantly below. They're sort of more like, I think, about 150, 160%. I've said, well, what happens if it comes back to 170? So still stays well above where it's been in the past as an average, but it just sort of falls there gradually over the next sort of 5 years. So if that's the case, and there's some other economic factors behind which we sort of preset some of these for you, and then you can go in and change them if you like. But that's the outlook there. We've got the gross rental yield. You can see what the effect is on that. So that would put the yield back to their sort of 10-year average. The property price to full-time wages would fall from current levels, but it would still be above its sort of 10-year average. And the mortgage payment relative to full-time wages would sort of fall to 75%-ish. Again, miles above the long-term averages. So we've been pretty friendly. We've basically said, interest rates are going to fall from where they are. The mortgage payment to rent is going to revert back to a more normal level, but it's still well above its 10 and 30-year average, and all the other factors are sort of well above their longer-term averages. And you can see on the line as well at the bottom there, I've got the rental growth, lots of real rental growth coming through. So the next slide then I've got shows what that would do. So we've got the grey dotted line is if I bought a property, that $1 million property with no debt, you can see that I basically make a little bit of, over the next 10 years, I make a little bit of money from it. Not very much, but it's certainly positive. If I borrowed the 80% that this is assumed, then I'm going to be down sort of $200,000+ over the deal. And then you can see on the right what's doing that to you. So I've got my entry. So I start with my 200,000. I've got some entry costs that sort of knock off a bit. I get all this rent, or it's either rent that I receive or rent that I don't pay. Either however we want to look at it. Then we've got these ongoing property costs. You've got your interest costs, which is by far and away the biggest chunk of that. And then you get this positive change in your property value, and net effect is you basically end up dusting most of your $200,000 by having that debt and having to pay that interest. So so in terms of that perspective, that's a relatively friendly version, and still ends up not looking particularly good. If you want to go down the more the more negative point path is if I threw in exactly the same effects, but now I went to 7% interest rates. Now you're getting your property actually isn't going down by that far over this. So you can see by the time 2032 rolls around, you're only slightly behind where you started. That's that grey line at the top. But you've dusted sort of $600,000 in or $700,000 in paying the massive amount of interest over that time period. Now, why doesn't property fall that much? Well, the property doesn't fall that much because embedded in these assumptions, we've put some relatively large rental growth increases, and so the idea is that your yields, if you're growing at I think it's about 4 or 5% per annum, your rent's growing 4 or 5% per annum, then that sort of helps to underpin that the cost of your the value of the property. So even though we've sort of got the rates coming back, and again, we've got it coming back to 170%. You can probably see from that other mortgage payment graph, like that's well above the 10-year average, well above the 30-year average. If they went back to the 30-year average, there's a lot further from the fall for those properties to fall. So, if it went back to sort of its 30-year average of say about 150%, then you can knock another 20% off the value of the property. So, yeah. So that's those. Let me jump on and do a live example though with a calculator, just so that people can see how it's meant to be used, and then sort of look at the rental. How you can look at that in terms of rental versus renting and versus an investment in, say, the stock market as well. So, am I live?
Yes, that's coming through.
Yep. Okay. So, so you can choose either a house or a unit, and you can choose where you want which major city you want that to be in. You can see as well, so the rent's in here. So I've got this $1 million, $200,000 deposit. You can go and put that whatever you like for that. But and actually, I had a complaint the other day that the property prices don't go up. I think it sort of caps out at $2 million or something. I think the idea was that, and you're right, we probably add another million to that. But I didn't want to sort of put in $10 million, $20 million houses because I think they don't trade on the same metrics. I don't think anyone buys a $20 or $30 million house thinking about the rental yield they're going to get, and we're going to put somebody in this house and they're going to pay it off for me or whatever it is. I think that they trade on other metrics. But yeah, so if you change between units and houses, you can see the rent is changing down here. And sort of saying that, okay, well, the average $1 million house, is basically giving you a 2.9, just under a 3% gross rental yield at the moment, which is monthly, 2.5. And then if you went to a unit though for $1 million, you're going to get a much higher yield on that. And same with if you pick different cities, the yields will change depending upon which city you choose to sort of match that city. So then you go to the next screen and you choose the economic environment, whether you're expecting a very bad economic environment to a good or a property paradise. And you can mouse over the eyes and you can see that property paradise would be quite high inflation, quite high wage growth, really good rental growth, mortgage rates falling back to 3.5%, and what's happening with shares. So I've just gone with a moderate scenario, which is mortgage rates of 5%. So not much higher than where they are today. Inflation of 2.25. And then sort of more normal rental growth and wage growth. So if you go to that, you can change all those later, but that's just sort of preset ones we've just got in there to make it a bit easier. Then you sort of choose this point about saying, okay, well, here's where I can see in this line, here's where the current ratio is for mortgage cost to rent. And I can say, well, what happens if I think that's going to be closer to, 100, if I feel it's going to fall to 121%, or I can see that, okay, the 30-year average is 1.4. I can sort of change this to go, let's say it's going to go back to the 30-year average. What does that actually mean? Or I can choose to do it mortgage cost to wages, same graph. So it's currently at 85%. I can say, oh, look, let's say that fell back to the 10-year average of 60%. And and then keep going, and then you can use that of those other ones. So you can only choose one though. You choose one as your valuation method, and then we'll show you in a minute what what that means. So let's say I'm going to use mortgage cost to wages this time of 60%. Okay, that's going to send my property price down. I can see the, if I look at this detailed output, I can see that, okay, I've got my mortgage property full-time wage going back to its 10-year average. What does it actually do to these other ones? That actually sends the, that's mortgage price to full-time wage back to the 30-year average, which sends the mortgage payment to full, sends the other ones down to the 10-year average. Then I can go in and adjust all these assumptions. So if you want to go in there and say, okay, well, look, we've got real wages growing at 0.5% and inflation at 2.3. If you said, oh no, look, I think it's going to be, we're going to be running at 5% inflation for some time, things will look a lot better. Because so now you haven't lost as much because inflation's running really high, and but then if you inflation of that and mortgage or interest rates of so anyway, choose your different variables, and that will sort of give you the where the property will come out. Then once you've done that, I might actually just start with let me just refresh the whole thing and start with a brand new version. That's because I'm not 100% sure what I've changed there, but
and Damien, just to make clear, there's a few viewers asking in the chat. If you want to see the calculator, if you want to use the calculator, you go to nucleuswealth.com/property-calculator. We've got a few other calculators under the resource tab on the homepage as well. So feel free to check those out too.
Yeah. Okay. So I'm back to I think I'm back to where I was. Just my assumptions. Yes. Okay. Excellent. Okay. So I've got this property one. Once I've got that, then I can do a comparison to buying. And what that does is it then says, my first question is, look, what are you going to do with your money, and what type of return are you going to get on it somewhere else? So if you're just going to say you're going to stick it in the bank and you're going to get 3%, because we've got mortgage rates going to 5 or 6% or whatever, and you're saying, okay, I can get 3% just sticking it in the bank, or in government bonds. Then you go, okay, well, on day one, you're 150 grand better off renting versus buying because you don't pay all the stamp duties and all that type of stuff. Now, depending upon the capital growth, you can then see year by year how much cash flow does that actually mean. So if you're renting, you're spending under this scenario 27,000. You're buying, you spend 45 on your mortgage, and other costs as well. And I didn't actually show that. There's a whole section on other costs in terms of your insurance payments and your annual fees for if you're in an apartment, repair costs, all that type of stuff like that, and depreciation on various things is all sort of put in there. So you can change. We've sort of defaulted it, but you can go in there and change all those assumptions if you like. And then you sort of see what the capital gain or loss is, and what the cumulative amount and sort of the net amount you gain. So obviously under this scenario, it looks good. But if I went back to my let's go back to a property forecast and say we wanted to make this so that it looks much better, and we said, okay, mortgage rate's going to fall back to 3.5%, and now we find properties. It is tough sometimes to get this to look good in the current scenarios. Maybe we need to put mortgage rates down a bit to so we go back into another crisis, but we're still getting lots of rental growth and lots of wage growth. Okay, so now I've got this property where it's going up, and you can look and say, okay, well, what about versus the rent though? Now you start off in front, but because you skip the stamp duty and everything, but then that sort of gradually erodes away as you get that capital gain coming through. And then you can sort of see there that by the end of this time period, you're $125,000 over 10 years. You're $125,000 worse off because of all the capital gains that we've put into that assumptions. But so that's your versus rent. There's a similar one versus shares. Now the shares, you go in and say, look, currently here's what the PE is. if you sort of said this is just on Australian shares, go, okay, well, let's say it's going to go back to maybe 14 times, but earnings growth is going to be quite weak. And then you're paying 1% in fees or whatever it is, and that you can sort of see what are shares doing over that time frame, what's your debt property doing. So in the case I had here, we had some quite bullish assumptions in terms of the property, but it's going to be behind for certainly the first year, because you've got to pay out all your stamp duties and everything and to get in. But then as time goes on, because we've got lots of debt in here, the property eventually overtakes shares, because it's a good market for property, and these assumptions were put into there. So so anyway, so there's all those types of things. A lot of this, the key reason why I created this really was to show people that the price of mortgages really, really matters. It was this point that as we went through this 20-year period where mortgage prices just falling year after year after year, and it blip up a little bit but then start falling again, and that meant that people could then afford to have bigger houses and afford to spend more, and that kept on pushing property prices higher. It very much looks like we're in the opposite direction now, and so that's I guess I created this so that people can go in, and if they disagree with what I'm saying, and they go in there and show me what you're expecting, and it might be that you're expecting that property prices, to mortgage, if you look at the mortgage cost to rent, you might assume that's going to go to 300%. That people will pay $3,000 a month, or $3,000 a week for a mortgage, rather than $1,000 a week to rent the same house. And if that's true, then property prices will go higher. But I guess what I'm doing is I'm trying to bring that back to the two things I think really matter, which is that the amount of rent on the same house versus the amount of versus the mortgage cost, and the amount of the people are actually earning to the mortgage cost, which I think are the key drivers, and they're the things that will hold property prices to a more reasonable level. Anyway, I've spoken monologued enough.
Nice one, Damien. So just again, nucleuswealth.com/property-calculator. Go in there, have a check it out. There's obviously lots of different functionality that Damien's just talked through. So this is the last call for any viewer questions before we get into the investment implications. Just drop them in the chat below, and we can answer any after this segment. There's been lots of discussion in the chat, so that's good that people are engaging. Now we've got our viewer question of the week. So this is for viewers to have some discussion in the comments section over the coming days. And the question for this week is, which will give, interest rates or house prices? So feel free to post your thoughts and engage with us and some of our other viewers over the coming days. Now I'll pass it back to you, Damien, for the investment implications.
Yeah, thanks, Sam. So look, as Matt Hayes' comment is, yes, it's you need a unicorn scenario to make houses look good at this point, and maybe it'll come, but it is it looks like it's going to be very tough given the way interest rates are going up. So there's a question now. You've really got to weigh up this idea of rental growth versus interest rates versus house prices, and which one of those is going to be the most powerful one there. At the moment, it's interest rates. Rental growth is certainly booming, and if it keeps going the way, if you can get rental growth growing 10% per annum, then that cures a lot of ills. In terms of house prices, probably creates a lot more problems in terms of social problems. But that's and I think as well, it's worth noting that rental growth has never really grown at those rates. It tends to grow at inflation, so over sort of medium-term periods. So if you disbelieve the interest rates, and because you think that by interest rates going up that far, that's going to crash house prices and basically cause a recession, and that's our belief, is that what you want to be in is you want to be bonds, you want to be in international stocks, and I guess with a qualification that getting the timing in the international stocks is now exactly the right time. Well, it's certainly better than it was 6 months ago. We still think there's a bit more weakness to come. We think earnings are going to sort of roll over, and we're about to hit reporting season, and we'll start seeing possibly the initial signs of that. But bonds and international is where the key ones to be looking for. If you believe the interest rates and you do think that that we're going to sort of 7% mortgage rates, you want to be out of anything to do with housing. You want to be hedging your international holdings because you'd expect under that scenario as well that the Aussie dollar is going to be rising. You've got to some of the other key factors out there. What's happening in Europe and the Ukraine. If you've got a view that nothing's going to change anytime soon, and we have that view, gas prices are going to stay high, which is going to be a negative for many for individuals. It's going to be a drag on earnings, so it's a sort of a negative, and it's going to pull company earnings down. And then in Australia, probably the key measures is what's happening in China, and particularly Chinese property. It still looks pretty dire, the Chinese property situation. You've seen a number of headlines come out recently talking about the amount of extra debt that China's going to throw into its infrastructure. And there's two ways to look at that. There's certainly, I feel as if a lot of Wall Street's looked at that as a glass half full. And only now are they starting to come around to considering actually maybe actually that glass is half empty, because the amount of infrastructure building over in China really hasn't changed that much. It's up sort of 10% ish, but the problem is they've actually having to spend twice as much debt to get that growth as what they thought they're going to have to spend. So they've reached the middle of the year and already run out of their quotas. So they're bringing forward quotas from next year to invest this year for debt. And that's not because they're building extra infrastructure. It's because they're still building the same infrastructure they were. They just don't have any money to build it. So they've had to bring forward the debt. So, So and when you're building infrastructure in China, you don't use much iron ore and you don't use much copper in building a road. The real things that use that is buildings, and the building in China is still very much on the way down, and does not look like it's recovering anytime soon. So pick your belief on interest rates, but our take is very much the bonds are, as I've been saying for a little while, bonds are where to be, and international stocks as you think that earnings are finally bottoming. We still think there's some room to go before earnings bottom though.
Excellent. Thanks, Damien. We've had a couple more comments come through. Jerry, in relation to question of the week, he's thinking house prices are going to give for sure if they can't get this inflation under control. So there's been some really good comments coming through today. So that almost wraps us up. Damien, thanks again for sharing your knowledge and insights and for putting on this great show.
Thanks, Sam.
Cheers. So we do welcome your feedback on this podcast, especially in relation to future topics. If you do have any ideas, please drop it in the comment section below or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com/contact and you can book a call with me or one of the team. Don't forget to like the video now. And finally, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. And also, if you'd like to see more of our previous episodes or content, head over to nucleuswealth.com/content. And to stay up to date with us, with news from us, you can also follow us on all major social media. So for myself, Damien, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.